Fellow risk takers, this is your worst. Podcast host Andrew Stotz from A. Stotz Academy, continuing my discussion with Larry Swedroe, who for 3 decades was the head of research at Buckingham Wealth Partners. You can learn more about his story in episode 645. Now, Larry stands out because he bridges both the academic research world and practical investing. Today, we're diving into a chapter from his recent book, Enrich Your Future, The Keys to Successful Investing. And that chapter is Chapter 17, there is only one way to see things rightly. Larry, take it away.
Yeah, so as always, we'll begin, Andrew, with an analogy to help people understand the concept. And one of my favorites is to utilize sports because many people understand the concept. It's related to sports. So one of the players who's considered one of the greatest players in the National Basketball Association is a fellow named Stephen Nash. Now, if you looked at his career statistics, that are the two that people probably look at the most, Steve Nash averaged over his career, which lasted 18 seasons, he averaged just 14.3 points and just 3 rebounds a game. Now, despite those kind of mediocre statistics, he was named an 8-time All-Star, a 2-time most valuable player, and is generally considered the greatest point guard of his era. So why is that? Well, he happened to also have over 8 assists a game, which is one of the highest in the history of the NBA. But Nash made everyone else around him a better player. And today, when we do more sophisticated analysis with sports, for example, in the National Hockey League, you also see not just goals and assists or saves for the goalie, but for the players on the ice, you see a plus minus score. So a guy may never have many goals or assists, but when he's on the ice, his team outscores the other team. And it's because of his contributions making the other players around him better and being a defensive player as well. So there, it's the point being that you should never look at things in isolation, but how it impacts the whole. So the expression is there's only one right way to see things, and that's in the whole. So what does this all have to do with investing? Well, Harry Markowitz, who's one of the fathers of modern portfolio theory, pointed out that you should never look at the risk and return of an asset in isolation, but you also should consider how its returns and risks co-vary with the other assets of the portfolio. Okay. And to show that point in the book, I give the example of the 25-year period from 98 through 22. The Vanguard 500 index fund returned 7.53% per annum, and it outperformed their emerging market fund, which returned just 16.14%. So it outperformed by almost 1.5% a year.
And
And
you
on
said you
top of
said
that,
16, you meant six, right?
six, sorry, six,
Yep.
I'm sorry about
So
that.
seven and
6.1,
7.5 and 6.1 roughly. Okay.
right.
Yep. Keep
So
going.
almost a 1.5% difference. And on top of that, the volatility was roughly 16% for the S&P 500, and it was almost 23. So why would you ever want to invest in this and include this emerging market
Yeah.
fund in the portfolio?
And
Well, the
and let
reason
and
has to
let
do with its.
before you go into that, let me just, help people visualize that. Here we have a a fund with a lower return and a much higher volatility. How could you ever benefit from bringing that into a portfolio that has higher return and lower volatility? It seems impossible that that would have any positive impact on a portfolio.
Yeah, and if you ask the vast, vast majority of your audience, I bet they would say, if you had the choice, would you include that? The right answer would be, I don't know. I need to see the covariance of the portfolios to see what the correlations are. If the correlations are low enough, right, then you can benefit because when the S&P 500 dramatically outperformed, you would buy more to keep your portfolio in balance. Say you wanted to have 10% emerging markets or 20 or 30%. Now, instead of 10, you're at 8, or instead of 20, you're at 18. So you would buy more and sell some of the S&P when it had done really well, and vice versa, right? When if there was some periods when the emerging market fund did better, which was the case of most of the early part of the first decade of this century, then you would sell some of the emerging markets fund and buy more of the S&P to put you back in 500. Well, it turns out if you did do a 90-10 allocation, I showed that you would have increased your return from 7.5 to 7.6, and you would have had the same Sharpe ratio, so same risk adjusted return, but you would have actually earned a higher return, and it would have even been slightly higher returns also if you included a 20 or 30% allocation to the fund. I've even seen examples. There was an extreme case in the 90s when if you added Turkey to a portfolio of US stocks at a time when Turkey had negative returns, but it was negatively correlated with the S&P, and the volatility was so high that you were selling when it went way up because the volatility was way high, and then you were buying when it crashed and you got it cheap and it would eventually recover. Even though it had negative returns for the whole period and dramatically underperformed, you would have been ahead. And too many people do a line item analysis and look at each item to see how it's done in the portfolio instead of considering how the total portfolio did because of its inclusion. And that's really the moral of the tale here.
Hmm. Yeah, it's one of the things that always comes to mind, and I think we're going to cover it in another chapter, is, what do we do about the fact that in the past, let's just take Turkey as an example, that it behaved, perfectly. It was perfect, great correlation. But then we say, well, okay, is that going to repeat itself in the future? How do you respond to that when someone, asks you that question?
Yeah, well, I wouldn't use that as an example to illustrate the common sense of that. What I would look at is to see if there is common sense about should you expect there to be low correlation, and should you expect there to be risk premiums, which would allow you to invest, and that low correlation is there. So it is logical to believe, well, the correlations of emerging markets and international stocks are going to be positive and maybe even fairly high to the US because we're all subject to some of the same economic cycle risks, especially when we have global systemic crises like 2008, for example, or if we had a Persian Gulf War and oil supplies were disrupted, it would be likely that all equities around the globe would be negatively affected. But the fact that the correlations are not perfect, when things calm down, there will be some periods, almost certainly, when emerging markets underperform, and there'll be some periods when they outperform relative to the US. And that's common sense, and that's a good reason to diversify because you're adding unique sources of risk. And there are other better cases where you see absolutely no correlation with something like reinsurance, because earthquakes and hurricanes don't cause bear markets. And generally, with maybe some possible major exception, earthquakes and hurricanes are not going to cause global bear markets. So there's logic, even if the data happened to coincidentally for some period showing a high positive correlation, the odds are good that was luck because there's no logic behind it. So you want to look for the logic of should you expect low or at least not extremely high correlation. And any asset that is imperfectly correlated should be at least considered to add in your portfolio if it meets the other criteria that we've talked about of
Mm.
having a premium that's persistent, pervasive, robust to various definitions, has logical reasons for you to expect it to continue to persist.
So the last thing, and we're gonna get off this call, but the last thing is last week we talked about different funds that are alternative and providing much lower correlation. I did some work on that, and what I was struggling to find was are there any ETFs, or are they all going to be structured as funds?
Um, there, a good example of a fund that's available in a mutual fund
Mm.
is AQR's Alternative Risk Premium
Yep.
Fund that goes long short four different factors: value, what they call defensive, which is buying high quality and shorting low quality, uh, momentum.
Yep.
So it goes long stocks, bonds, commodities, and currencies that are doing well versus ones that are doing poorly. And the same thing for the carry trade, which is buying and selling stocks or currencies or bonds that have higher yields and shorting the others. So it turns out that not only are each of those factors low correlation to stocks and bonds, but they're low correlation to each other.
Mm.
So, I mean, it's possible that AQR could turn that into an ETF, although it might be difficult because they have 500 or 700 positions,
Mm.
making it difficult to replicate in an ETF. But in theory, you could. If someone created an ETF of reinsurance risk, that would make sense. Private floating rate credit might make sense, although that is difficult because they don't have liquidity. That's why that's in interval funds. So most of the assets are likely to be in either
Funds.
private vehicles or interval funds, which often means you're also earning a illiquidity premium
Mm.
because you're giving up the ability to trade it daily, and people love liquidity, even if they don't need it. And you get rewarded with generally a large illiquidity premium if you're willing and able to take that risk.
So for those in the audience, just go to Black Swans, Chapter 8, and Larry talks more in detail about the AQR style premium alternative fund and what it's doing and the value that it brings.
Here's an interesting point about that fund, Andrew.
Yep.
That's very important. And again, it shows the low correlation. The fund is now in existence. This, I think, is the 11th year. The first 5 years, it performed just about as you would have expected. 4 of the 5 years were positive returns. It yielded, I think, something like a 4 to 5% risk premium above T-bills, which is what we had estimated it would be. And then the next 3 years were god awful. Lost like 30% or maybe a bit more as a drawdown. Lots of people fled the fund, never to return, right? And because of the problem we've discussed of recency bias and thinking 3 years is a long time when any risk asset will go through at some point much longer periods than 3 years of poor performance. So most of the money left. The next 4 years, including this year, have been spectacular returns, something like 20% a year for the 4 years. And including 2022, when stocks and bonds both did poorly, and yet the 3 years it did poorly, stocks did well. So there's good examples of an asset you should love because it has low correlation. You're buying, if you have the discipline, after it does poorly when the expected returns are higher. And now you've been selling some, taking advantage, especially in 2022. The fund, I think, was up 25% when stocks and bonds got killed, both losing double digits. Unfortunately, most investors were not around because they panicked and sold. Same thing happened with reinsurance for the Stone Ridge Reinsurance Fund. First 4 or 5 years were fine. Next 3 bad years in a row, people 80% of the investor money fled. And then last year the fund was up 44.5%. I just checked this year after two bad hurricanes that just hit Florida back to back, the fund is still up 22% or something like that for the
Mm.
year. But again, most investors aren't there for recency bias, even relativity bias, and they need to. And you should love assets like that
Mm.
because if they don't have periods of bad performance, then there's no risk. Because all you have to do is wait 3 or 4 years and the returns will turn around. But we know that can't be true. So you want to, that's a reason why you want to diversify, not avoid an asset class. So that prevents you from having all of your money in the asset class that happens to do poorly. Say you're a Japanese investor in 1990, after the most spectacular returns in history for Japan over the previous 25 years or so, right? They were on top of the world. Japan at that point was something like 2/3 of the global market cap.
Yeah.
And now it's 20% of the market cap or so. And they've had zero return for 34 years virtually, right? So the same thing could happen in the US. I'm
Yeah.
not predicting that, but it's possible. And investors make the mistake of treating the highly unlikely as impossible, and what they think is the highly certain, the highly certain as if it will happen when it may not.
Mm. Well, let's end it on that, Larry. I want to thank you again for another great discussion about creating, growing, and protecting our wealth. And I'm looking forward to the next chapter. And the next chapter is chapter 18, and that is Black Swans and Fat Tails. Makes me think of
Yeah.
the Black Swan book.
Yeah. Well, thanks for having me. Glad, hopefully this was helpful, and we'll see you next week.
Fantastic. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.